Hey everyone, thanks for tuning in. Today I want to unpack something really significant happening in the world of nickel, specifically concerning Indonesia. Now, as you probably know, Indonesia is sitting on this incredible wealth of nickel, positioning itself as a key player in the electric vehicle revolution. But there's a bit of a storm brewing behind the scenes, particularly for the companies actually mining that nickel. It all revolves around a new government regulation number 19 of 2025, which adjusts mineral royalty rates. It came into effect very quickly back in April, and it has the Indonesian Nickel Miners Association, known as APNI, seriously concerned. They're sounding the alarm about the future profitability of the entire sector. So what's the issue? At its heart, APNI argues these new royalty rates, which can range from 14% to 19% for raw nickel ore and 5% to 7% for processed forms like ferro-nickel and nickel pig iron, are just unrealistic right now. They believe these rates place a progressively heavier financial burden on miners, especially given the current market conditions. Why now? Well, APNI points to a kind of perfect storm. Firstly, global nickel prices have taken a significant hit over the past year, meaning revenues are down. Secondly, operational costs are climbing. They mention things like rising fuel prices, minimum wage increases, and even a hike in the VAT. On top of that, there are existing financial burdens. APNI actually lists 13 different types, from taxes and levies to the massive investments needed for smelter construction and crucial environmental responsibilities like land reclamation. So the picture APNI paints is one of falling income and rising costs from all directions. And now, these higher royalty rates are being added to the mix. They see this as a serious threat, potentially leading to a domino effect, lower profits, less investment, and maybe even hurting Indonesia's competitiveness on the global stage. If Indonesian nickel becomes too expensive, buyers might look elsewhere. They also fear potential mass layoffs if processing plants become unprofitable, which is a huge concern given how many jobs are tied to this downstream sector. Now, here's a fascinating technical point APNI raises. They're worried these higher costs could actually impact Indonesia's long-term nickel reserves. How? Well, it's about the cutoff grade. Think of it as the minimum percentage of nickel in the rock that makes it economically worthwhile to mine. If costs go up, partly due to higher royalties, companies might have to raise that minimum threshold. This means rock with perfectly usable nickel, but below the new higher economic cutoff, gets left in the ground, potentially forever. So, paradoxically, trying to get more revenue now could shrink the country's economically recoverable reserves in the long run. Given all this, what's APNI proposing? They aren't just pushing back. They have a specific alternative. Their main focus is on revising the mineral benchmark price, the HPM. This is the official price the government uses to calculate royalties. APNI argues that the current HPM formula significantly undervalues nickel commodities compared to actual market indicators, like the Shanghai Metals Market. They estimate this undervaluation might have cost the industry billions in lost market value already. Their solution? Update the HPM formula. Specifically, they wanted to include the economic value of associated minerals often found with nickel, like the iron in saprolite ore and the valuable cobalt in limonite ore. They believe these valuable byproducts aren't properly accounted for in the current HPM. What would be the impact? APNI estimates that properly valuing these components could potentially increase the HPM by over 100%. And here's the key. They argue this would naturally increase state revenue because the base price for calculating royalties would be much higher without needing to hike the actual royalty percentage rate. It sounds like a potential win-win. More revenue for the government, but achieved through a more accurate price benchmark rather than a higher tax rate that squeezes the industry. APNI believes a more realistic HPM would also improve miner profit margins, allowing for more investment in exploration and environmental management, and make mining lower-grade ore viable again, preserving those long-term reserves. So, what we see here is a clear tension between the government's need for revenue via higher royalty rates and the industry's concerns about profitability, investment, and competitiveness in a challenging market. APNI's counterproposal isn't just resistance. It's a push for what they see as a smarter, more accurate, and potentially more sustainable approach centered on fixing the benchmark price itself. They're actively engaging in discussions with the government, hoping for a more collaborative solution. It really highlights the complex balancing act governments face between immediate fiscal needs and the long-term health of crucial industries like mining, especially in a globally competitive market. It's definitely a situation I'll be keeping a close eye on. That's all for today. Thanks for joining me for this deep dive. Until next time.